Well, good morning, everybody. We've got some exciting updates on Vitae, the Vitae residences in Denton. It's our newest acquisition that we're closing on, hopefully the end of this month. And so we've got some very exciting news on that. And value plays are coming back. And so now we have adjusted this to be more of a value play with a cash out refinance. So that's very exciting that we have a cash out refinance opportunity. So I wanted to update the numbers for you and the whole plan and business plan and tell you how we've modified it, or at least that's how we are right this minute, and let you know some of those exciting changes on that. Okay. Vitae Residences, again, for those of you who don't remember or don't know, is a 2016 build in Denton, Texas, adjacent to TWU University, and it is a student housing project. So there's 90 units, but 132 leases because of the one bedrooms only have one lease, but the two bedrooms have two leases. And it's managed a little bit differently. And but it is also, in our opinion, very mismanaged and a lot of other opportunities to be involved with on this. So like I said, there is a lot of exciting updates in this presentation. So there's some good stuff you need to hear, because this deal just got a lot better. Okay. So here we are, Vitae Residences in Denton. I just told you about the location. We are only paying $135,000 per unit. And so that's extremely low for a 2016 build in the city of Denton. And so we think we're getting a great deal. And we're getting a great deal because we believe it's mismanaged. And so it's a management value play. Closing costs, $625,000. Capital improvements, we budgeted $300,000. We're funding our operating account with $150,000. Now I put miscellaneous at $375,000. And quite honestly, that's partially a placeholder because of negotiating with the lender. And that's, some cushion in case there's some proceeds that change due to interest rates before we close. Or we might be able to use that as an additional deposit for to help get a little bit lower interest rate, because we are doing bank debt on this one now. We're looking at an $8 million loan. And this is from a local bank we've done business with before. And I like that because it's flexible. Now, the terms of that loan, let me jump down here. I'm budgeting 8%. That could be anywhere from 7.8 to 8.1 as we look at what the current spreads and index are. So that fluctuates. And like I said, that extra $300,000, I'm hoping I might be able to get a little bit lower cost if we put that in as a depository account, an additional cushion for us, just in case, but I don't think we'll have any problems. Again, we plug that in at 8%. We've got 2 years of interest only, and then it converts to a 25-year amortization for the final 3 years. But we're looking at the possibility of interest rates going down. So we are plugging in a refinance in year 3. And that refinance then is $10 million. And I plugged in 6% interest rate on the refinance to come up with what our numbers are. Again, student housing adjacent to TWU, 2016, great condition, management value play. And our returns, they were 16.1 projected, now they're 16.7. So it got a little bit better. And so those are kind of some of the high level. Now, our unit mix, A1 studios and A1s. The only difference between a studio and the A1 is they have a door between the two rooms. You can see the same square footage. So we are actually planning on just marketing those as all A1s rather than a studio. Just has a little bit better marketing feel to it. Now, we have these projected rents, okay? And here's something that's very interesting. Like I said, this is student housing. Over 30% of the leases have already been renewed for September of 2024. Again, student housing, they plan on staying there for 3 to 4 years. And because of that, they renew those leases. The increases are already built in and they pre-lease those. So 30% of the property is already pre-leased at rates at this level or higher. So we've already got those built in. We're already achieving these rents and those are already built in for September. So that's an exciting side of it, that we already have the leases expired at our projected rates. So that gives us a whole lot better comfort level. Now, our capital improvements, we budgeted $40,000 for roof repairs, exterior paint and wood, $90,000. Updates to the pool, deferred maintenance of $50,000, and that's just a placeholder. There's not really much. We need to update the locks. So we've got $70,000 in there because the way that they have it is with this weird plastic key. So we're updating all of those to make that more efficient. Now we're also looking at the possibility of moving the fitness center as part of the office. The office has a very, very large club room. It's actually huge and it gets very little use. So move that over, move the fitness center over and be part of the common area in the office, and then take the current fitness center, which also looks like a temporary building, not all that pretty, and make that our maintenance shop so we can have more supplies there because they don't really have a good shop on the property. So that is something else we will change. Okay, so we've got our current projections per the owner, okay, and our new projections of what we plugged in there as far as income. And again, we're budgeting $1,543,000, and that's based on a 6% collection loss on the numbers they are already achieving. So that's very exciting. Our other income we actually took down because there's a little bit of confusion that we had to plug in here because the seller's financials, they just started kicking in the other income starting in September. So we adjusted that to be a little more conservative. So we're only looking at raising the collections by about $75,000. So a very minor increase in overall collections. And just so that I can see what that is, since I don't know that off the top of my head. So we're only looking at raising collections by 4.21%. Year over year, between 22 and 23, in that difficult market, we still raised rents in collections by 10% portfolio wide. So we think we're being pretty conservative here. We also updated all of our expense numbers with our projections, with our actual budget. We did projections early on. Now we've had the management company go in there and do their budget. And so we put in the budgeted numbers. So our operating expenses came down a little bit, $9,983 per unit, which is still extremely high. Part of the reason for that is because we are all bills paid, so to say, and then we bill back for water, gas, electric, and starting in the fall, internet. So like I said, we should be able to beat that number. Given our income, 884. I had to plug in that, 640,000. Again, we mess around with this quite a bit, but so the first 2 years are 640,000, the interest only, okay? 640,000. So we did a sponsor pro forma that's where we think it's gonna be. And if we do really good, what that'll look like. And if we screw it up, what that'll look like. So again, the screw up doesn't look too well, $11,000 loss, but if we do really good, it could go as high as 271. But we like to be accurate, conservative in our numbers. So we're assuming $168,000 in actual cash flow. Debt coverage ratio 1.38, cap rate 7.3 on projected numbers, 5.7 on actual. Cash on cash year one at the property level is 3%, and a debt yield for our numbers people that like to know all the details. And of course, the debt coverage ratio and the debt yield are what we use, what the bank looks at when giving the loan. Now again, this is a bank loan. It is 5 years, fixed interest rate, and no prepayment penalty. And the reason we went that direction, number one, it's a bank loan. The agency debts had, the agency loans had lower leverage amounts, so our loan amounts were lower, and we would have a fixed interest rate, which would be over 7%, and we would have defeasance. So if interest rates went down, then we would have massive prepayment penalties if we refinanced. With this loan, we don't have the refinance to agency or sale restrictions, so there's no prepayment penalty on that, which saves us money on a refinance and gives us a better opportunity for that cash out refinance. Okay. Now we extrapolate out just like we did before, 4% rental increases, 2% expense increases, collection losses. We actually go up. We've got vacancy loss at 6% and collection loss at 2%. Okay, that is going forward. So here, our vacancy and collection loss on our pro forma is 6% for year one, and that's these numbers. But we are putting in an additional 2% in collection loss / vacancy loss in years 2 through 5 to have another cushion. Because if we, for example, kept it at 6, if we had 6% vacancy and collection loss, like we projected for year one, then our return goes up to 18.5 also, okay? But we want to make sure that we are conservative in our assumptions, and I'd rather have that extra cushion in the deal. Okay, so our expenses get extrapolated out and go down here to our cash flow. So we're looking at a 3.2 cash on cash property level return, 3.5, 4.7, 5.7, 6.7. So that's all good. Now, if we plug in a 6% cap rate in year 3, okay, it gives us a value of 16 million. We are all in at 13.6 million. So we're creating $3 million in value in 3 years without cap rate compression. Okay, so we didn't want to put any cap rate compression in there. Now I also plugged in a 65% refi, so that would be a little conservative. Previous years we've done a 70% refi. Pay off the existing loan, 2% in costs gives us proceeds of $2,167,000 that flows through to the partners. Now I do anticipate that cap rates still go down and interest rates go down over 5 years. So I plugged in a 5.5 cap on the exit, going from 16 million to 19.5. So creating an additional value over those 5 years. Sales cost 2.5, loan payoff of 10. And again, these are projected numbers. And so bottom line is, what can you expect for you? So an average $100,000 partner can plan on getting 2.5% cash flow year 1, 2.8 year 2. Now you'd have a 3.8 cash on cash from the cash flow, plus another 30%, 31% from a cash out refi. So again, exciting times. We can get back to a cash out refi projection. And so that's an exciting aspect to add on here. Then year 4, another 4.6 based on the original 100,000. And year 5, 5.3 plus proceeds gives us a total cash to the partner, which is right in line with what our previous projections were, but now with a cash out refi in year 3. So a 1.83x on your money projected over 5 years and 83% overall total return on investment, which is 16.7% per year average annual return. Like I said, I think this is a very exciting opportunity. We are looking at that cash out refi and a value add proposition, which we have not had in a very long time. So this is an exciting time. Now, Blackstone projected that this was the bottom of the market right this instant, that this month was the bottom of the market and it's going to be going up from here. So really now is the time to start buying. So this is our first acquisition right now. So get off the sidelines, get into a great deal, and get your money working for you with decent cash flow returns, but a cash out refi plus the plus depreciation, which we use accelerated and bonus depreciation. And also, you may not have heard this, but they're looking at reinstating and extending the Trump era tax reform for bonus depreciation, accelerated depreciation. And they're also looking at making that retroactive so that we go back to 100% rather than it scaling down like it's been. So there's a possibility of about 50%, 50%, of your investment being a tax deduction in year 1. Again, we don't know where that's going to pan out, but we will do a cost segregation and bonus depreciation and get that in the equation as well, which is not calculated in the overall returns. So very, very excited about this opportunity. Like I said, Vitae, it's a beautiful property, 2018 build that we're paying 135, all in at 151, and going to have a great deal. Like I said, we're already achieving the rents. They're already renewing at that level, and we've got our budgeted numbers in there, and the cash out refi for overall good returns for the partners. Now, again, we've been able to exceed our projections on most of our properties. And so I think we're in that position again. So again, a value add deal with a cash out refi. So an exciting time to be involved. So reach out to us, get involved in this property as soon as you can. Like I said, we are closing at the end of February. February 29th is our target date, and we are only raising 5.6. I think we already have commitments at about $4 million. So if you are interested, you definitely need to jump on this now and get your money in now. So, like I said, wonderful deal. Love to have you as a partner. And thank you so much. Have a great day. Thank you so much. Bye.